Now that Thanksgiving is over, are we headed for a market crash? That's the question we'll answer in this video with our weekly stock market review. Now, like always, we're going to do this review with our research from MacroOps, our global macro research firm. So this is just a sample of what we send our clients, but it's very good stuff. And the way we're going to start is going over our sentiment gauges. And in this case, they are qualitative sentiment gauges. We're not using hard numbers. We're kind of just looking at the sentiment in general based off headlines and things like that. You'll see as we get into it. Now, why is sentiment important in measuring how the stock market is doing? Well, that's because the stock market is made up of people, right? So we always got to be focused on the person. What are investors thinking? Because whatever they're thinking is going to determine how their money is moving. And sentiment is kind of an inverse indicator. So that means that if everyone is really bullish, that's a bearish sign. And if everyone is really bearish, that's a bullish sign. And the easiest way to simplify that and understand that is just to think of cash levels, because cash is what you need to buy stocks, right? So if everyone is super bullish, that means that they've probably already bought all the stocks they could with the money that they have, which is why at that point, where can stocks go from there? If you can't buy anymore, then they're not going to rise any higher, right? They could only fall. Same idea, but vice versa. If people are very bearish, then that means they have a lot of cash on the sideline ready to go back into the market. So that's a bullish sign, because at the end of the day, what do you need for the stock market to keep going higher? You need buying. And for people to buy, they need cash. So our favorite qualitative sentiment gauges to understand what people are thinking come from MarketWatch's homepage and the most read articles banner, which we'll show down below. Bloomberg's real yields show on Fridays, and CNBC's Fast Money, just the first and last few minutes of the show. This kind of gives us an idea of what people are thinking. So this right here is an example of MarketWatch's homepage, and what we did is highlight all the bullish headlines in green and then all the bearish ones in red. And what's happening, because we track this every week, is that we're seeing more and more green bullish headlines. But that doesn't mean that's bad for the bull market just yet, because when the bull market is ready to be over, or at least when we're ready to see a correction, we should see all green headlines here. You can see there's still some red headlines, some bearish ones. When this is all green and super bullish, that's when you could kind of look at the market and say, hey, we might be turning around here. Like we say here, expect this page to be marked in nearly all green by the time this rally is good and done. So from that sentiment gauge right there, just headlines, this qualitative aspect, we could say, hey, the bull market is just fine. We are not too bullish just yet. If you want another sentiment indicator, the Bank of America bull and bear indicator is really good. They basically aggregate sentiment and positioning indicators. And positioning is basically where are people actually putting their money. And right now it is neutral. So if you see right here, they do it the same way. When people are extremely bearish, you see it's a buy signal. This arrow will be over here. When people are extremely bullish, that's a sell signal, and that's how sentiment works. Now we're going to get into what we think is going to happen towards the end of the year and into 2021, so keep watching. So what we're thinking is that we're probably setting up for a rocky start to 2021, and that's just because of how much money is flooding into the market right now. So again, this is more data from Bank of America. They've seen record inflows into various markets, including equities right here, which has found the second largest inflow ever into value stocks, and the fourth largest inflow ever into small cap stocks. And you've probably seen lately small caps like this IWM have just been on fire. They've been the ones taking off while the S&P and the NASDAQ have kind of been lagging in comparison. So it kind of makes sense we've seen the fourth largest inflow ever into them. So Bank of America's FMS cash rule is close to a sell signal. Now, what is this cash rule? Well, it's basically what I explained before about sentiment and people keeping their cash on the sides. So what does this cash rule mean? Well, basically it's what I explained before with sentiment and people keeping their cash on the sidelines. So if this is triggering a sell signal, it's because cash is at a low 4.1%. And basically what they're saying is that people have less cash on the sidelines, and these are fund managers, not just people, meaning that they're already bought a lot. And what happens if you're fully invested, like I was explaining before? Well, there's only one thing you can do, right? Sell. So this would be a buy signal if this was above 5%, I think it is, because that means there's more cash on the sidelines ready to go into the market. So again, all this stuff kind of connects. So what we're thinking is that we will see a fast climb into January, causing positioning to catch up with sentiment, meaning what? The sentiment is bullish, right? So more and more people are going to be investing, making the sentiment even more bullish, but eventually you hit a point where you can only sell. So that will lead to an eventual unwind starting mid-January and lasting a few months. We expect the correction to be more sideways than down unless we see long end yields spike more than expected. So everyone's going to be real bullish going into the holidays. We're going to see a nice run potentially, but then in the middle of January, we're likely going to see that consolidate again. But instead of going straight down into a market crash, it's more sideways action as sentiment resets. Because again, for the thing to keep moving higher, you need more bears once again. And that's our theory as long as the whole interest rate picture doesn't change. Now, we've still got some more analysis on equities, but let's take a little detour towards gold and Bitcoin real quick, because they are also important to track big things happening. Keep watching. So gold, at least the gold ETF, GLD, saw its largest daily outflow in over 7 years last week. And you can see right here, gold has been on a downtrend. Now, gold is basically working off their technical overextension, meaning they shot up too fast, too high, and the crowded positioning that they had. So a lot of people too bullish. It goes back to sentiment again. So it was due for a correction. We still think there's a long-term bullish trend with gold, especially with how much money printing is being done. And this is likely closer to the end of its correction instead of the beginning. Now, when we're talking about gold, I also want to talk about Bitcoin because this run has been awesome. And you can see we almost had a little correction, but it looks like we are just recovering just fine. And we've talked about this before, but the big difference in this Bitcoin run versus the one in 2017 is that this whole bullish run is being pushed by institutions. And that's important because we're not just having like Uber drivers and retail traders talking about Bitcoin all day. This is real big money that are strong hands that are investing in Bitcoin for the long term. And if you remember in 2017, there were so many cryptocurrencies, all these different coins, right? And there still are. But back then there was way more noise where you didn't know if Bitcoin was the one that was going to survive. There was talk about Bitcoin Cash and Ripple and all these different currencies, right? But now a few years later, when we're seeing this run again, it is in Bitcoin and these institutions are investing in Bitcoin. So it's in this second run that I'm way more interested. I didn't care about Bitcoin at all in 2017. But now it looks like the smoke has cleared, institutions are getting in, so it's becoming more solid. It won't be as volatile. And with the amount of printing that we're doing, you know, that thesis still stands, right? Alternatives to the dollar are going to be gold or Bitcoin. And before, you know, we could have argued whether they would actually use Bitcoin as an alternative currency, but the fact that these institutions are getting in, these big money people, well, that gives it more legitimacy. So with that being said, I feel more comfortable investing in Bitcoin and kind of buying and holding. I'm not going to trade it because I don't have a strategy like I do with stocks, which you guys know all about, the Fallible trading strategy. So with Bitcoin, what I will potentially be doing is putting 5% of my net worth in it and just holding. Now, I know that's nothing crazy, 5%, but it should be a good chunk of money. And that's just what I feel comfortable with, you know, investing in Bitcoin and buying and holding. I'm not going to sell it. But the important thing to remember is that this rally and this whole bullish trend is way different from the one before this, because what we needed was that institutional support. Now, going back to gold, one good way to look at it is in comparison with equities or stocks. So this right here is a ratio chart between the NASDAQ and gold. And basically what we're seeing here, if you look at these green lines, is that gold and equities are following a similar relationship that we've seen before the start of the last two major bull cycles. So if you think stocks are too high right now and won't get much higher, well, when you look at a data point like this, the truth is that yes, they could get much higher. When we look at breadth in the market, which is how many stocks are going up versus how many are going down, because for a good bull market rally, you want a lot of stocks moving together, not just a few of them holding up the whole stock market. For a strong, in-depth rally, you want breadth. So the potential major market breadth signal that we're seeing right now is saying that the bull market is just only beginning right now. You can see here, this blue line is the total percentage of stocks above their 50, 150, and 200-day moving averages combined. And they haven't reached this 80% level that they're reaching right now since the previous extremes in 2009, which was the bottom of the market, and 2003, both after those huge crashes. So we're getting to those levels right now, which is very bullish. This has only happened 2 times in the last 20 years. Earnings and economic data, they continue to surprise to the upside. And you know, of course, earnings and econ data, they're important to look at. But what's really important is to look at how people are reacting to it. So what's really surprising here is how low the expectations still are. Because you would think with consecutive positive beats, because we continue to beat their earnings estimates each time, and good vaccine news, that analysts would have, you know, made their expectations higher going into Q4, but they haven't. There's still a very low bar, even though it looks like Q4 and the subsequent quarters are going to look really good. And why is this important, looking at the expectation versus the reality? Well, because that's how the stock market moves. So when an earnings report comes out for a stock, the actual numbers that come out aren't as important as the investors' reaction to those numbers. Because investors are expecting, say, 5 cents per share in earnings. And if the stock does 7 cents per share in earnings, you're going to see that stock shoot up. Where at the same time, if the company reports 3 cents per share versus 5, you're going to to see it collapse. So with that idea, the actual hard number doesn't matter. It's just in relation to what investors are expecting. It's all about expectations, going back to sentiment and everything. You always got to play the investor, not just the hardcore numbers, because they don't actually matter in a vacuum. They don't. That's why companies who barely make any money, you can see their stock price shoot up like crazy. So when we see something like this, when analysts are still having very low expectations, well, if they think that everyone's going to lose money and all these companies just make a little bit of money in their earnings, then they're beating expectations. So that's what we mean when we say they're setting a low bar. And the low bar is good because it's easy to clear, and that means higher stock prices. Now we got a few more data points to look at to kind of put this whole bull thesis together, and we got a stock that's looking really good right now. So we're about to jump into that right now, so keep watching. Buybacks, these are a very important part about pushing the stock market higher, because in the last few years, a lot of the upward movement in the stock market has been caused by companies buying back their own shares. And why are they doing this? Because they have money, so much money, because interest rates are so low, you can borrow money and just buy your own shares. And what does it do? It inflates the stock price. So this year, buybacks were obviously slashed because, it was not a good year. But these US corporates have built up a considerable war chest of cash. You can see this change right here. Cash change is 516. They have a lot of cash built up. And where is this cash going to go? Back into the stock market. That's what we like to see. We like buybacks if we're long stocks. Now going back and looking at the S&P chart, what we've seen in November, as long as we close strong today, I'm filming this on the last day of November, and this is a monthly chart right here, so we're looking at monthly closes. We've seen a nice outside up bar following an inside outside inside bar. What's all that mean? Well, basically it's bullish, especially look at this big nice candle right here. The correction we saw before recovered very nicely. So as long as this holds, which it looks like it is, as of today, as I'm looking at the market, as long as it doesn't collapse by the end of the day, there are high odds of further upside going into the end of the year. So another signal. And a big key here for the stock market was this 3,600 level in the S&P. And we did in fact close above it with the weekly close. If you look right here, this green bar above 3,600. So what we want to do is stay above this level because that was a big resistance. But of course, as I keep talking, the market is fighting with that resistance right now. It's down 1% at 3,600. By the time this video goes out, we'll see where it's at. But that's a level we definitely want to hold. If it broke, that would be bearish. Now, like I said, I had a stock for you, right? And that stock is TripAdvisor, which reminds us a lot of Twitter because it's an amazing product with a captive, loyal audience, but it's extremely mismanaged. Now, even though it's mismanaged, and you can see this kind of terrible chart, it is very cheap at this point. They just did a full user interface makeover, and they're integrated with Vrbo, and they've greatly expanded their revenue mix with an aggressive move into dining and experiences. So they're doing the right thing, sort of. But the big thing is that the whole CCPV is going to be in the rearview mirror next year, and people are going to want to travel, and TripAdvisor is in a good position to benefit from that. So yeah, management sucks, but the stock might benefit from this move back to travel anyway. So this is definitely one to keep your eye on. Now, as we said in this video, we are still very bullish on the stock market, and everything looks good going into the end of the year. And then around mid-January, we might see some action like this, like we saw before, sideways, for a few months. But remember, this key point right here is the 3,600 level, so we need to watch that. If it breaks that, then we need to reconsider what's going on. In addition to all that, there's another extremely important aspect that every investor needs to actually survive in the stock market. Way more important than this research or anything. And you don't have to believe me when I'm saying it, because Warren Buffett himself talks about it. And we actually did a breakdown of exactly what he says is the key that every investor needs. And it's in this video right here. So go ahead and click this video, because on top of all this research, this is really what you need. So click this video and I will see you there.